An analysis of that explosive 36% one-day surge in Sable Offshore Corp stock after it got that key pipeline approval.
Right, the PHMSA approval.
Exactly. And a key theme here is this idea of a major existential threat being removed, proving a massive binary bet correct.
And the analysis makes a really strong case for that, highlighting the regulatory win and the potential for a short squeeze.
The foundation is incredibly solid. I mean, the analysis clearly identified the major risk.
It all came down to whether PHMSA would ever allow the Los Flores lines to reopen.
And now that that hurdle is cleared, that massive sort of all-or-nothing risk is gone.
It's resolved. But that shift is exactly where the analysis needs to evolve now, right?
Yes. While the PHMSA approval resolves the ultimate binary risk, the analysis needs to pivot its focus from the regulatory victory to the operational complexities and, the interim risks leading up to that Q1 2026 restart.
The report needs to stop celebrating and start detailing the roadmap.
We see that a lot, analysis getting stuck on the catalyst itself.
Exactly. The material rightly emphasizes that approval means SOC goes from, zero revenue and a fatal flaw to being on a path to produce something like 28,000 barrels of oil per day.
And the core assumption behind that boom headline is that the pipeline being a go means cash flow is now inevitable and imminent.
But the reality of operational restarts, especially offshore, is it's rarely that simple.
That premise is sound. But I wonder if we've really accounted for the sheer scale of restarting the Santa Ynez unit after it's been shut down for years.
This isn't just flicking a switch.
No. And to make the analysis more robust, for, say, a long-term holder, the report has to acknowledge that the simple yes-no risk is now replaced by a much more complex how and when operational risk.
The market is pricing in certainty of execution right now.
But the next 18 months are filled with execution risk that needs to be systematically detailed.
Precisely. Sophisticated investors get that the PMSA win was massive, but it only gets the company to the starting line of a marathon.
So if the report focuses too much on the thrill of the surge,
it overlooks the new set of questions. What about unexpected corrosion? Or what if the specialized staff you need just aren't available? These are the real-world risks that now dictate the timeline.
So the suggestion isn't to be bearish. It's to be pragmatically bullish by showing the path is understood.
Absolutely. So to strengthen this, the report should have a section that really identifies the specific operational stages between now and Q1 2026.
Like, what exactly has to happen?
Yes, explicitly address the time, the cost, the complexity of preparing the Santa Ynez unit. You need to forecast the CapEx, the money for maintenance and repairs.
And that CapEx is critical. That money has to be spent before any revenue comes in.
Correct. The analysis should also talk about potential delays, staffing needs, and what interim spending is required to get that facility certified after being dormant for so long.
Without that, the enthusiasm rests only on the announcement.
Exactly. By detailing the execution, you convert an emotional rally into a real investment thesis.
Okay, that shift from existential threat to execution analysis is a crucial step, but let's talk about the delivery of that news.
I think I know where you're going with this. The tone.
The tone, yes. The use of highly charged, aggressive language, while it fits a high-energy style, it risks undermining the credibility of the really robust financial data that's presented.
It's a mismatch between the data and the delivery.
I can see what they were aiming for with that high-impact style. I mean, the report leans into the emotional side of it, the vindication.
The boom headline, for sure.
Yeah, and phrases like the market was proven wrong, calling skeptics haters, and saying shorts are absolutely trapped. It injects a lot of emotion.
But wait, isn't some of that high-energy antagonism part of what sells a turnaround story like this?
That's a fair challenge.
Do we risk sounding too dry if we take out all the emotion, especially for a stock that just popped 36%?
It's a good point. The energy is infectious, I get it, but the analytical payoff is in the details, right? The PHMSA ruling, the production volume, the economics, which are all stellar.
Okay.
When we use that kind of antagonistic language, we shift the focus from the strength of the data to, the writer's own vindication.
Ah, I see. It suggests the confidence comes from emotion, not from the financial modeling.
Exactly. The goal is to convey strength through insight, not just volume. The sophisticated investor is looking for rigor over emotional satisfaction.
So we want the report to be shared as a primary source of data, not just a celebratory narrative.
Yes. That way, the analysis appeals to a broader, more institutionally minded audience.
Okay, so to maximize credibility here, we suggest a stylistic pivot.
How so?
Well, instead of focusing on the emotional state of trapped shorts, maybe reframe that section. Focus on the objective magnitude of the required short covering. Talk about the volume dynamics driving the price.
I like that. It moves the discussion from the shorts are suffering to here is the technical pressure fueling the rally. It's analytical.
Precisely. And then replace broad statements like Wall Street was proven wrong with something more precise, like the market significantly mispriced the regulatory approval probability.
It still has the same confidence. The market was wrong, but it elevates the tone.
The report should look like the winner, not act like one.
That stylistic shift makes a much stronger case for why those high analyst price targets are actually achievable.
Which brings us to our third area.
Strengthening the valuation argument.
Right, by contextualizing the time lag and the discount rates. This is where it all ties together. The regulatory win, the operational risk, and the future price.
Let's dig into that section on valuation.
Okay.
So the analysis says that at $10.36, there's still, and I quote, 100% upside potential just to meet analyst consensus. It's referencing targets in the $20 to $29 range.
And in notes, the stock was at $35 earlier this year, which reinforces that recovery story.
It does. But here's the critical caveat. That projected revenue doesn't actually start until Q1 2026.
That's a long way away.
That potential is compelling, but the 18-month delay needs some explicit discussion about, the time value of money.
And the risk. Analyst targets in the high 20s often reflect a fully operational, de-risked company. SOC isn't there yet.
So the connection between today's price and that future target isn't fully established, especially with the execution risk we just talked about.
Right. A sophisticated reader knows that money today is worth more than money promised in 18 months, especially when that promise hinges on a really complex operational restart. If we don't address that time gap, it weakens the conviction behind that 100% upside claim.
It's crucial to acknowledge that the market is valuing that risk today. Not just the delay, but the risk that Q1 2026 could slip to Q3 2027 or even later.
That uncertainty needs to be modeled, or at least addressed. The price of $10.36 isn't just a low valuation, it reflects a discount for time and for execution uncertainty.
So how do we integrate that nuance into the from burn to earn section without making it a finance textbook?
Keep it focused. First, I'd suggest a brief analysis on the implied risk premium that's embedded in the stock's price right now, given that 2026 timeline.
So basically explain how much risk the market is demanding for waiting 18 months?
Exactly. It shows the analysis understands the mechanics behind the current price. It contextualizes it as rational, not just cheap.
Okay, and the second part?
Second, and this is critically important for solvency, the report mentions SOC is losing a lot of money. A negative operating income of $110 million last quarter?
Right.
For the analysis to be truly robust, it has to address how SOC plans to bridge that financial gap. How will the company's liquidity manage that ongoing burn rate before the pipeline turns cash flow positive?
That's the real sticking point. If they burn through their cash before the pipeline is online, the whole thesis just collapses.
Absolutely. Does the company have enough cash? Are there debt covenants? Is another financing round coming? You have to address the most pressing concern a sophisticated reader will have, which is solvency.
Ignoring that $110 million burn makes the whole valuation feel disconnected from the company's immediate health.
Exactly. Addressing those liquidity concerns transforms the valuation from just an aspirational forecast into a robust financial roadmap. It proves the company can survive the journey.
Okay, so this is a really powerful report. It's built on fantastic technical knowledge.